So the first and foremost, we call ourselves now the InvestSMART group. Part of that group is InvestSMART, which was the company I founded back in 1999. InvestSMART's always been about the tools and products more so than the content. And that was a problem for us because what we realised is a lot of people making the same mistakes. We built these great comparator tools where people just ambulance chased returns. And we realised that they usually got into the products at the highest point of the market rather than actually having an investment framework. So we needed a voice. We bought Intelligent Investor in, I think, July 2014. And Intelligent Investor gave us much needed research and content, or a voice for Australian equities. Intelligent Investor started around the same time as InvestSMART back in 1999 or around then. John Addis found that company. He's still with us today. And they've got an amazing track record. I think since 2001 we've had independently audited results, and they've outperformed the market by about 3.5% every year since 2001. So Gaurav's going to talk a little bit about how we pick stocks and how we build our portfolios in a direct equities portfolio later on. And we bought Eureka Report. How many people here are from Eureka originally? Yeah. That was on cue. Eureka is, Melbourne's our stronghold for Eureka, by the way. Interesting enough, we started InvestSMART in Brisbane, so Brisbane had a lot of InvestSMART people and Sydney has a lot of Intelligent Investor people. Eureka was much needed for us because the way we see the world is by asset class more so than by direct equities, and a lot of what we're going to talk about today is how we see creating an investment framework using asset classes in your portfolio rather than just picking stocks and going to a barbecue and your mate tells you to buy X, Y, Z and you buy that as a barbecue tip. So Eureka gives us a wider voice over many asset classes, and that's important for us. Some stuff coming up in probably the next couple of months is we're expanding Eureka to cover off on SMSF advice. We know that a lot of our members are SMSF trustees and run their own SMSFs. The ATO tells us that many of us are non-compliant with our rules in SMSF. And so something we're launching in December is a dedicated area to SMSF compliance and retirement. On the Intelligent Investor side, we've hired 2 new analysts to cover small company stocks, and I think we launch in December with a special report on small companies, and I think we've got that portfolio half full at the moment, so it's taking us a while to actually pick the undervalued small companies that we believe are undervalued, and we're just building up that portfolio in a little while, but a special report comes out in December on that. InvestSMART, we've been doing a lot of work on our portfolio manager, which is a lot of the stuff I'm going to be talking to you today about. So what causes the biggest risk to our long-term returns? What we believe is the biggest risk to long-term returns, introducing my mates, fear and greed. We've all heard it before. Fear and greed in itself is not what is the risk, it's how we react or don't react to that fear and greed. What fear and greed does do is it creates noise in the marketplace, both short-term and long-term. So the Donald Trump effect a couple of weeks ago, which Tony explained, was short-term fear, and we all, or some of us, may have reacted on that. Interesting enough, Tony put out an article, and this comes back to our Eureka voice. He put out an article at 3 p.m. on Wednesday afternoon when the market was down 3%. The Dow was down about 700 points on the futures, and we put out a message to all of our members saying, "Slump Trump, don't panic." And it was perfect timing. A number of people complained that they didn't get it because they don't visit the website every day. We informed them that the InvestSMART app, we notified everybody on our InvestSMART app. On the same day we put out a recommendation, I think, for PMP. Is that right, Gaurav? PMP?
Yeah, I think so.
And a lot of people, the next day it went up 8%. Now we can't guarantee that every stock we pick goes up 8% the next day, but it was an interesting sort of situation where a lot of people saying, they don't get the email until Wednesday night, or they don't get the email until Saturday, they don't visit the website every day. That's why we've created that app. I mean, it's really important. We don't put out everything we publish on our websites, but the stuff that we think is important, we notify you via email. I think another thing we're coming out with in the new year is SMS alerts on recommendations as well for those people who want to get SMS alerts. So fear and greed creates noise in the marketplace. Some of that's short term, some of that's long term. It's how we react to that that is the biggest risk to our portfolios. What's been affecting markets as long-term noise, and this is an interesting chart, is low cash rates. Now what this shows you is real cash rates and nominal, so the difference is inflation. Both of those are very important. What that does for us in our portfolio, if people think about it, is it forces us into growth stocks. So when the government wants to grow the economy, they lower rates. We all sort of know that. What we don't sort of know is how that affects stocks long term. And so what I wanted to do is just show you a couple of charts of how the hunt for yield has affected stocks over the last 3, 5, 10 years. This is a chart of Cochlear. What I've mapped it against is the inverse of the 10-year bond yield. So what the inverse means is as the cash rates have gone down, Cochlear stock price has gone up. The correlation is uncanny. And this is what we're all doing at the moment, or we have been doing for the last sort of several years, is we're chasing yield. And what I want to show you later on is the portfolio manager, which shows you your asset allocation, and the whole of our sort of 80,000 portfolios, or about 60,000 members who use the portfolio manager to track their asset allocation and where they are today. And it's quite concerning, and that's why we're using our voice at Eureka and Intelligent Investor to say, hey, take a look at your portfolio manager, make sure you understand where your risks are, make sure you understand your asset mix, and make sure you're comfortable with that asset mix compared to your risk appetite. This is Transurban, same sort of phenomenon. But it's not just Australian stocks, it's also US stocks, and I can go through thousands of others. So this is Johnson & Johnson in the US. Pretty much all of these stocks that have good yields are basically tracking the inverse of the cash rates. And it's not just individual stocks, it's also the Australian market and the US market as a whole. So this is the 10-year average PE ratio of the market in Australian equities. And currently we see it sort of 20% above its long-term 10-year average. And we're not saying Australian markets are going to crash. What we're trying to get across today is we don't care and we don't know. And why we don't care is if you've got the right asset mix, it doesn't really matter. Yeah? And if you've got the right time horizon, it doesn't really matter, because in another 10 years I'll show you this chart and it'll be the opposite. This is the US equity markets, 25% above its long-term 10-year average. Again, we're not saying the US market's going to crash. What we're saying is that the hunt for yield across the globe is causing us to go into growth assets such as international equities, US equities, and property in Australia. And we're not saying that any of those are going to crash. We're just saying you need to know what's in your asset mix, what would happen if something changed, and those, for example, cash rates going up, and how that would affect your portfolio, and are you happy with those risks? So as I said, our universe, the way we see the world at InvestSMART Group across Eureka and Intelligent Investor and InvestSMART is by asset class. So what this chart shows you, it's quite complicated, but each year, each different asset class performs differently to another. So green on each row shows the asset class that went up, and red shows the one that went down. And as you can see, asset classes behave differently each year and every year. And so we think at InvestSMART, it's your investment framework and having that discipline that will be the biggest risk, or the non-discipline will be the biggest risk to your portfolio over the long term. So what I wanted to do is show you, I mean, it all sounds easy. We all sort of like know not to put all your eggs in one basket. So why don't we all do it? The problem is that it's very hard to know. There's a number of portfolio managers out there. We've sort of like changed ours a little bit, and we've spent the last few years on developing this. Most of the portfolio managers out there really just show you your Aussie stocks, and so it's just one asset class and what's gone up, what's gone down, some dividends. We do that as well, that's great. This product, by the way, is free. This tool is free. What we're more interested in is all of your asset classes. And so what this portfolio manager does is it looks under tens of thousands of securities. It looks across all your managed funds, it looks across equities. So just because an equity is on the Australian stock market does not necessarily mean it's Aussie equities. It could be an A-REIT, so we say that's property. It could be a hybrid, so we say that's bonds. It could be a Magellan fund, which we say is 100% international. So just because you've got Aussie equities in your portfolio doesn't necessarily mean that you have no exposure to other asset classes. The other interesting thing is this is my portfolio. So this is live, and I'm going to be a bit risque today with Sexpo next door, and we're going to try to do a live demonstration, and hopefully it works. So my current portfolio is 92%. So what we do with the portfolio is you put all your stocks and funds and whatever else in, and then we work out your asset class, your asset allocation. We then compare that against what we believe is an expert asset allocation across the different risk appetites, such as conservative, balanced growth and high growth. And then we tell you where you're underweight or overweight. The idea is not to get to 100%. Yeah, it's just to get you to a point where you're comfortable with your asset mix. So I'm 92%. I'm pretty comfortable with that. I'm sort of overweight a little bit of Aussie equities. I'm underweight international equities. I'll show you our members' portfolio soon, which is even worse than this. My property is a little bit underweight. I just sold my unit beginning of this week, and I'm slowly going into some of our diversified portfolios, which Mitch will talk about soon. Now we're going to do So this is the website where the tool is. Now, everybody we've had a couple of problems with logins across websites. I'm sure some of you probably experienced that. We only bought Eureka in May, and so we had to sort of like quick catch up. Luckily, we've got sort of 12 IT people that worked around the clock to fix it. We've now centralised all membership. So your login and password for whichever website you use the most should actually work across Intelligent Investor, InvestSMART and Eureka now. It's just one membership across the three websites. So if I go into my portfolio manager, what you can do is you can set your risk class, your risk profile, whether you're a balanced conservative, and it's based on time horizon. We believe the biggest thing about your risk profile or your risk appetite is really how long you have in the marketplace to ride out the ups and downs of the market. So a conservative person, we're saying 3 or 4 years. A balanced person's more like 5 years. A high growth or a growth person's more like 7 years plus. We then give you a health check, which I explained, where we show you your underweight or overweight a given asset class. You can then go in, and the biggest change to your portfolio or your health check over time will be how you change your risk appetite over time. Your risk appetite when you're young or whatever is going to change across, the upcoming 30 years. So I'm currently high growth. When I get a little bit older or a little bit more conservative, I may change I might change mine to something like conservative. And it'll have a disastrous effect on my health check score. And it'll show now I'm well overweight those growth assets of Australian equities or international equities. This is just a tool. It's not saying that your portfolio is wrong just because you've got a bad health check score. It's just saying that your risk appetite does not match your asset mix. And you can't have both. Yeah, so you can convince yourself that you love Aussie equities, but you can't convince yourself you're also conservative. You can't be both. Then what we've done is we've allowed, so that's a great tool, and it looks through all of the asset classes and all the securities you have. But what next? So then we've created a place where you can have a play. We call it our sandpit. And then, so you can go in and go, well, how would I affect my health check score? How could I improve my health check score? So currently and this is what I was saying, we look through so I've got, a wholesale geared growth, and that's the asset allocation for that individual fund. But then I've also got a perpetual one. So, oops. And so what's the asset allocation for, the perpetual one? Sorry, you guys can't see it that well. And then we put all of those together. compare it against what we believe is a conservative or a growth, and we say where you're underweight or overweight. What the improve your portfolio allows you to do is go, right, well, I'm overweight 6% in Australian equities. I'm going to get rid of my blue glass, which is a really bad performing stock. And I'm underweight international equities, which everybody is. And I'm going to, so what it's showing you up here is I've got 32,500 cash surplus from selling those blue glass shares. And I'm going to go and put $32,000 into international. And then it shows you the transactions required here. It's just a sandpit. It allows you to sort of simulate changes to your portfolio without actually affecting those changes to see how that could improve your portfolio. And hopefully, if all things go right, my health check score has gone up to 94%. Now I'm only fiddling around, between 92 and 94. A lot of portfolios that our members have, they're down at 50% or 60% because they're well overweight Aussie equities or property. And I'll show you that in a minute. So that's the portfolio manager. It helps you know where your risks are against your risk appetite and what we believe is a conservative portfolio mix or a balanced portfolio mix. So why does the portfolio manager, why does your asset allocation matter? I went into the health check and I put in a portfolio that I thought was a balanced portfolio in 2001, and then we followed that through with some spreadsheets and whatever else behind. And what I want to show you is why rebalancing matters and why your asset allocation and that asset allocation, that health check score changes on a continual basis. So asset classes go up and down, so my health check score will automatically change. Every Friday we send you an email and says this is your health check score. If Aussie equities go flying through the roof, your health check score will change. It'll change with prices of different asset classes going up and down. So in 2001, I had a balanced portfolio and I had a 98% health score. I was pretty comfortable with that. And then along came, and then in 2001, I went to a financial advisor or whatever. I got given a balanced portfolio of shares and funds. It was about 98%. Over the next 7 years, international equities and Aussie equities went flying through the roof. If I did nothing to my portfolio during that time, with those stock prices going up, my portfolio in 2007, I still think I'm balanced, would have been down at 73%. Then what happened is I actually still think I'm balanced. I don't think and now your 50% of your portfolio is in Aussie equities or international equities. GFC happens, you lose half of your money. Yeah? Now everybody thinks that's fine because then 2009 was the low of the market. I just sat there, it would have come back, my time horizon was fine and all's good. The trick is that if you rebalanced during that time, you would have had more money, because what you would have done is the health check score would have been showing you that you were deteriorating over those 7 years. In 2006, 2007 maybe, you would have started tipping out of international shares and Australian equities and into cash and fixed interest. That's what you were supposed to be doing, and that's what our voice at Eureka, if we were around at that stage, well, it was, an intelligent investor would have been telling you. Then, in 2009, when the equity markets are at a low, you would have been tipping, your health check score would have deteriorated further again, because now you are overweight cash and fixed interest and underweight equities. You would have been tipping out of Australian equities and international equities and into cash and out of cash and fixed interest and into Australian equities and international equities. But the trick is you would have more money because you lost less money on the way down because you were rebalancing, and now you've got more money to invest in those growth assets on the way back up again. You would have only lost about 30% of your portfolio, and you would have recovered a lot quicker than if you didn't rebalance at all. And that's what this investment framework gives you. It's really important that we continually look at our portfolios and we rebalance accordingly. So we say this a lot, and we say it in using our Eureka voice, we say it using our intelligent investor voice. But a lot of our members still don't listen. What this is, we've got about 6,000 of our 50-odd thousand members. So we've got 50,000 members using our portfolio services. 6,000 of those members say they're conservative. And this is their asset allocation mix on the left-hand side. And what we believe their asset allocation should be is on the right-hand side. and you can see they're well overweight property. We think property in a conservative portfolio should be about 2%. They've got about 24%. Well overweight Australian equities. That portfolio to us looks more like a high growth portfolio. You've got 7 to 10 years to ride out volatility. We've got 9,000 members saying they're balanced. Again, property's going up even more. Australian equities is about equal. And now our growth portfolio is 34% property, about 6% is we believe is the ideal asset allocation. Now the interesting thing here is the health check score for the growth and high growth people wouldn't be as bad as the conservative and balanced people, because we expect you to be in more growth assets as you're becoming more risk seeking in your risk appetite. But again, we think the mix is wrong. Yeah, we've got lots of people still overweight property, underweight international equities, overweight Aussie equities. And our high growth one, nearly 50% of our, and there's about 25,000 members of these, 44%, nearly half of their portfolio is in property. Now what we do in our health check is, or in our portfolio manager, is this is excluding your principal residency. This is investment property only. So you can still put in your investment in your residential property, but you can exclude it. And so we only count those people that have put investment property into the portfolio manager, and they're still this sort of weighting. So the problem that we see at InvestSMART Group is that it's difficult to get into international shares. It's difficult and expensive, and it's difficult to get into property for younger people. It's difficult to get into fixed interest. Unless you've got $500,000 and you go to the RBA and you buy a 10-year treasury, you know, most of us don't have that. So it's quite hard, and it's quite hard to get the asset allocation or the diversity within an asset class. So it's not only, and this is what Gaurav's going to talk about, it's not only just asset allocation across asset classes, it's also asset allocation within those asset classes. So within Australian equities, we choose a framework of value investing, which Gaurav's going to talk about. Inside of international equities, and why I've put on the left-hand side here, these are our portfolios that we tactically manage, and it's what Mitch is going to talk about. But our tactically managed ones is, are we overweight in respect to international equities? Do we go overweight Europe and overweight emerging markets like we have at the moment? Underweight US equities? How do you balance? A lot of people go, I need international equity exposure. I'll just go over to the US and I'll buy a couple of stocks. I'll buy Apple, IBM, whatever else. But you haven't got the exposure across the entire globe. You're just buying US stocks. Similarly for property, you've got commercial compared to residential. You've got US, so we tactically manage these using ETFs. So we have a portfolio of ETFs. We use ETFs. Mitch is going to explain a bit more about it. But we tactically asset allocate those across a number of different ETFs to get a broad diversification within that asset class. And then we've also created sector-specific ones, which are the ones I just spoke about, and we also, create the diversified ones. So there's a lot of people who go, I don't want to do any of this, I'll just let you guys do it. And so again, we use ETFs, but we do the rebalancing against the asset allocation, the asset classes, plus also within those asset classes. And then Gaurav's going to talk about actively managed, which is our II direct equities portfolios. So everything on the left and tactically managed, we use ETFs. And not every ETF is the same as every other ETF. And that's where we think we've got expertise in picking those different ETFs to give you the right asset allocation within those asset classes. So as you can see from what our members are doing in their own portfolios, we've built these tools. We've allowed them to see their asset allocation. A big part of our job still is education. It's going around doing these seminars saying, have a look at your portfolio, have a look at your asset mix, make sure it's appropriate to your investment time horizon and to your risk appetite. Thank you.